Hello, my name's Ali Khan and I've been trading for around 10 years, and 9 of those years I have specialized in algorithmic price action. In today's video, I'm going to go over my favorite model and what I believe to be the best model that you can trade in 2026. It's a relatively straightforward and simple model with very few moving parts, but today I'm going to cover some of those things and give you the real nuts and bolts of what makes a really high probability model. So one of the things that we're going to need when it comes to any model is understanding liquidity. For this specific model, we're going to be using session liquidity, so session highs and session lows. We're also going to be using fair value gap, so areas of inefficient price action. And thirdly, we are going to be using dealing range theory, what I call DRT, that we will use as a framework to find where high probability setups will occur. Now, before we move any further, without understanding higher time frame narrative, i.e. where the market wants to move to and why, it's very difficult to determine where high probability setups are going to form. And that's simply because when we are trading in the direction of higher time frame order flow, for example, if we're bearish, then ideally we want to see a buy side liquidity pool raided before we look for an entry. And obviously vice versa, if we are bullish, we're looking for a sell side liquidity rate. Now, we don't want to look at just any random old high and low. We want to ideally look at the liquidity relative to the previous session. The algorithm is always going to reprice to near-term liquidity first. And without overcomplicating this, I'm going to quickly run through a few charts here, and at the end I'm going to give you an actual real trade example based on the information I'm going to teach you in this video. So we of course have a chart here on gold. This dotted line here, I'm delineating the 12 a.m. New York Eastern Standard Time on a 5-minute time frame. Now, the reason 12 a.m. is important is because it's the start of a new day. It's the start of a new delivery cycle. So at this time, the algorithm is going to look back and is going to reference liquidity pools above the market and below the market. The opening price at 12 a.m. is a specific price point. It's a specific data point that the algorithm is going to utilize when referencing previous price action. Now, what do I mean by that? Well, essentially, we can use it as a filter. Now, for the sake of argument, let's say that we have a bearish higher time frame. We've seen a massive expansion on gold, and now the market is retracing lower. So the first thing we want to see is the market reprice above the 12 a.m. opening price. As we can see here, above the market, we have all of these relative equal highs. Now, above those highs, there's going to be buy side liquidity in the form of buy stops. So breakout traders are going to be going long once price obviously breaks towards the highs. Now, smart money anticipate this. And what they're doing is they're pairing that liquidity in the form of buy stops with short positions of their own, and they're going to offset those positions to opposing liquidity down here. Right? Now, I'll get onto that in a second. But firstly, we can see here a few things. We can see that at 12 a.m., the market's gone higher, collecting all of those buy stops. And then we quickly see it reprice lower with this candle over here. This is a sell side imbalance and something that we call a fair value gap. Now, what's important here is a few things. This displacement lower has traded through the opening price of these 4 consecutive up close candles. What this signals to the algorithm is a change in state of delivery, which basically means that the algorithm is finished offering buy side delivery, and now it's going to reprice lower by offering sell side delivery. That's the first clue that the market's turned around. Number one, we have seen a liquidity raid. Number two, we have seen a break and a close below this swing low. So we have seen a break in market structure. Thirdly, we have seen from this candle's low to this candle's high, we have a fair value gap. This will be our third thing that we are looking for to set up a high probability entry short. Notice that the liquidity pool that we rated was the previous Asian session. Now, this is where the algorithm will reprice to. Generally, if we have low or medium impact news. If we have high impact news, however, then it can often reprice to the previous London and or New York session on the previous day. That's why it's important to obviously look at the economic calendar to determine how far that price can raid. But let's say, for example, here that we didn't manage to get up here because, again, this is going to be a very difficult entry and you need quite a bit of experience to trade that high. What is better is to wait for the displacement, and then what you want to do is you want to grade the entire dealing range. Now, what do I mean by that? Well, if we have our lowest low down here and our highest high up here, what the algorithm is going to do is it's going to ignore the candles. The first thing it will reference is the highest price, which we can refer to as the dealing range high or the DRH, the lowest price, which is the dealing range low, the mid price, which we call our 50 DRT level, and then the prices in between each of those price points. So we have the 25 DRT here with this orange line and the 75 DRT here. Now, this is important because the algorithm is going to print arrays around these price points. Now, if you look closely here, inside of the fair value gap, we have that 75 DRT level that overlaps, which is also in close proximity with the 12 a.m. opening price. So this is a fantastic area to go short. It's also worth noting that nested at that 75 level, we also have a reclaimed fair value gap here. You can see how the bodies here are failing to close above that fair value gap. They're also failing to close above the 75 level and also failing to close above the consequent encroachment or the midpoint of that sell side imbalance. Not to mention, we also have this down close candle, which is a breaker. We have a high, a low, a higher high, and we also have those 4 consecutive up close candles, the bearish order block that I spoke about earlier. So what's happening here is that we're pairing time-based liquidity in the form of the Asian highs, the 12 a.m. opening price as a filter, seeing price sweep buy-side liquidity. We're pairing the 75 DRT level with 1, 2, 3, 4 different PD arrays, also with that 12 a.m. opening price. So this is what constitutes a really, really high probability setup. And it's one of my favorite models that has made me and my students a lot of money over the years. When we're trading this, we would set a limit order at the 75 DRT level. Our stop would go above the dealing range high, and our take profit would go at the dealing range low. Notice that we have a higher low to the right. This constitutes a low resistance liquidity run signature. Smart money are going to pair sell orders with the buy stops above the Asian range high, and they're going to offset those positions to the sell stops below the Asian range low. Now, when you apply higher time frame narrative, directional bias, economic calendar, and time of day to everything that I've just outlined over here, this can very quickly retire you. Now, let me go through another example just to give you a little bit more detail here. So we have here the euro dollar. Now, this is on the 4-hour time frame. Here we can see that inside of this range here, we have the highest high, which is our dealing range high, and we have our lowest low, or our dealing range low. Once we have these levels, of course, we can grade. Again here, we are looking for a continuation lower, since this higher time frame is trending lower. In this scenario, we have the market reprice higher after raiding some lows or balancing an inefficiency to the left. The market has repriced above the 50 DRT level, or the equilibrium price point, which is the fair price between the highest price and the lowest price. Ideally, we want to look for shorts above the 50 DRT level. Now, just like anything when it comes to price, everything's fractal. We can also divide each of these quadrants in half also, where we can find the midpoint of this premium quadrant. Now, overlapping that quadrant is this balanced price range. So we have sell side delivery going lower here. We have buy side delivery going through that range. And then we have sell side delivery back through that range. Now, this is something known as a balanced price range. A balanced price range generally happens in 3 stages. We reprice lower, we re-deliver higher, and then we rebalance back through that range. Now, notice all of the candles here, they're really struggling to get back above that range because it's been sufficiently balanced. And we see the rejection from that lower. Now, below the market, we also have this buy side imbalance between this candle's high and this candle's low. Notice that it also overlaps with the 25 DRT level. So this could be a potential target lower. We do not need for price to drop below the dealing range low. At the time of this recording, I currently have some positions on that I've left as runners, and I'm managing that position to see if we want to reach that dealing range low, but I'll show you that on the next couple of slides. So let's drop down into the 15-minute time frame and let me talk you through the actual trade. I was using that balanced price range inside of that premium area as the framework for this current trade, right? Now, notice here, in London, we create a high. So from the times of 2 o'clock in the morning till 5 o'clock in the morning, we have our London session. This is our London high, right? This is a key liquidity pool because it's inside of a key time window, which is our London session. In New York, what happens? We run our London session high, but notice that we fail to close above it, right? We also fail to close above the consequent encroachment or the midpoint of that balanced price range. And then look at the bodies here, they close well below. This indicates that the market is heavy and is likely to reprice low. Obviously, not everything in trading is 100%, right? So we're assessing probability. When we see this, and if we couple this with an SMT, which you can do your homework on, this gives us a solid trade idea. Now, watch what happens here. Again, we see the market reprice lower. It closes below this low here. This leg is a leg that raids the London high. Then, inside of the leg that breaks structure, we leave a fair value gap that's super important. Notice the overlap of the consequent encroachment with that fair value gap also overlaps with the 50 DRT level. This is how you know you have the right dealing range when you start seeing confluence from a higher time frame down to a lower time frame. Once all of this was set up, I was able to take a few entries. So I had an early entry. I'm not sure if you can see this clearly, but I had a sell entry up here. Now that's an early entry, is beyond the scope of this presentation at least, but I want to draw your attention to 2 more entries that I got down here, which was inside of this fair value gap, which is over here. Now it's a Tuesday, we have CPI later, so you want to be cautious when you're placing your stop. Now my stop was above the balanced price range, above the market. Now we have to account for the fact that we have a fair value gap above the market still, so we can easily reprice into that as we see overhead. But notice where the bodies are. That fair value gap is preventing it from going any higher. Again, another strong indication that the market here is heavy, and then we see the market reprice lower, again leaving a fair value gap. When we are bearish and we're assessing algorithmic order flow, these are the exact signatures that we want to see in price. Now, if you take the initial dealing range of this leg and you grade it, you'll also note the overlap with the 75 DRT, but I'll leave that for your homework. The point here is when you are trading in line with the algorithm and you're constantly assessing order flow, which is the whole point of algorithmic price action, fair value gaps and PD arrays are always going to overlap with dealing range levels. When we're looking for session highs and session lows as liquidity reference points, and we wait for that liquidity to be engaged, every single one of your high probability sells will occur after that scenario. So I hope this has been insightful. It's not exactly beginner friendly. Of course, you need to have some sort of understanding with algorithmic price delivery, but when you really have a solid understanding and you compare this model, there's very few moving parts. And again, I can get incredibly detailed with this, but this is a more foundational lesson. The hard part is knowing where the market, of course, is going to go. And that's the first thing that you should focus on. So I always suggest spending more time on the higher time frames. If you want more of these type of videos and trade breakdowns, then please comment below. Make sure you like and subscribe, and I'll continue making more videos like this. Take care.